Happy Thursday to you. We welcome you on the class of Trading the Trend. Now, that could be an interesting topic. It could be on stocks, it could be on options. If you'd like to learn more about ETFs, that will be tomorrow morning. So our focus for this class is stocks and options, ETFs tomorrow at 9:30 a.m. Eastern. Do not be late. Well, you could be late, but you're kind of missing things. Some big things actually going on after the Fed's announcement yesterday and kind of some of the commentary. We'll see that in just a second and tomorrow at 9:30 a.m. Eastern. Now, the question we ask ourselves every week is, what trends are you riding? Now, you should be thinking probably on a daily basis. What is on my balance sheet? What assets do I have? It's not usually the income just by itself that's going to push you forward. It's what assets do you actually have that is growing the balance sheet to try to push you towards or draw you towards where you want to be. What is on your balance sheet? When I say what is on your balance sheet, what are some of the positions that you actually have? Stocks, options, all the above, or whatever you choose. Be thinking about that daily. Now, just real quick as we get started, want to give us a quick reminder. We got Connie Hill with us in the chat. Say hello, Connie. Dean, Josh, David, Sam, Whack-A-Mole Trading System, Dom, and many others. Welcome to all. Let's go ahead and hop right in. Now, remember when we'll talk about stocks. We'll talk about also options. My gosh, you got Amazon's earnings today, Apple's earnings today. I mean, so much to talk about. Okay. And the semiconductors just by itself, some pretty big movements here today. So we'll hop right in. Now, remember, if we talk about options, remember that options carry a high level risk, not suitable for all investors. Also understand that this, when we do our examples, we will do them on the Paper Money software application for educational purposes only. Also, investing involves risk, including loss of principal. If we talk, and we will talk about short options, those can be assigned at any time up to expiration, regardless of the in the money amount. What does that mean in English? That means you could be the buyer of the shares, even though it's not at expiration. These are American style options we're talking about. That can be the case, not European, where it's only at expiration. Now, we're going to hop right into kind of some of the big movers that we're actually seeing. And we're going to kind of talk about these as far as how the markets are moving post yesterday's Fed announcement. And we'll also talk about kind of some current positions and new positions. We're going to kind of focus a little bit more on the strategy of cash secured puts and some of the variations of that. Now, just real quick, let's pull up. There's the SOX. Now, we know that the SOX had semiconductors. They've been falling down. It's not new. Okay, it's been going on for the last month. And so today, well, here's the thing. They can go down big, but they can also rebound big, right? Volatility is both ways. The neighborhood, the SOX, up nearly 8% here today. So like a couple of these stocks that are in, let's say the NASDAQ, and we'll just kind of show some, not everyone's going to be perfectly in semis, but some of these bigger names like SanDisk, okay, LRCX, that's more semis, big pop. You're seeing Micron, right? It's only up 16% halfway through the day. AMAT, okay, $64. I mean, these are big moves, okay, and WDC, and we'll talk about a couple of these in just a second. But some of these actually having a rebound. Now, when we talk about some of these technology names, let's bring up the NASDAQ. Now, by the way, if we were to ask a question, and this is to you, would you say that this has reversed? So when I say that, has it reversed the downward trend? That's a question for you. Speak now, forever hold your peace. Now, I'm not sure if we could say that. I mean, we got early signals, maybe a hold, right? We don't even have any of the moving averages actually turned green yet, not yet. If you go to actually the fifth chart in, which is going to be looking at the trend on the daily, there it is. More clarity. We don't even see that getting above the last lower high, okay? Now, here's what's kind of a little bit hard to understand sometimes is, so why do they go down so much? Why do they go up so much? Well, if you are actually short selling those stocks, which we talked about yesterday, if they're covering those positions, those bearish investors could drive the prices down. And then if they buy back, can push it back up and kind of create this lower low, lower high trend. If you look at the stocks and where we were at the prior lower low, this really being the lower high, we're not even above the lower low yet. If we're going to get some teeth in this move on semis, we need to get above 11,334. You get above 11,334, there could be some trading space, okay, right in here from about 11,334 to about 12,700. I'm going to say 12,650 to be exact, okay? Now, when we say trading the trend, what are you talking about time frame wise? I mean, 2 to 3 days to 2-3 weeks would be like swing trading. We're really trying to get that 2 to 3 weeks to 2 to 3 months. However, we're not foolish. We know sometimes those moves in the short term could be kind of interesting sometimes. I'm just kind of pointing this out. Now, why does this even matter? Okay. The reason why this matters is what we talked about on Monday, Tuesday, and Wednesday was really some income and value. Do we really want income and value to go up? Do we really want income and value to be the strongest areas of the market? Is that usually bullish overall for the market? Yes and no. Okay. Usually you like to kind of see some stabilization in the technology discretionary area and at least get those at minimum flat to somewhat bullish to help the overall market go to the upside. When I say overall market, I'm talking about the SPX. But you got to remember that equal weight, okay, that had been strong, pulled back in the last day and a half. But overall, if you're talking about, I want to see technology and these growth areas re-emerge, that's what you like, fine. Okay, I'm just telling you, we're just kind of talking about some of those areas that could be helpful. Now, if you look at it just real quick, the NASDAQ, you're going to see, is that reversed? I can't say that, okay? We're not even above the 10-day exponential moving average. So now here's the deal. Not everything in the NASDAQ looks like the NASDAQ or SOX. That's what we need to understand, okay? Not everything. Now, when you look at the Dow Jones itself, we're kind of sitting here trying to fight on this 30-period moving average, trying to carve out a level of support, kind of just neutral price range. Russell, what about Russell? Slightly below the 10-period moving average. We haven't reversed there either. And just super quick on the SPX, we have not gotten above the 10-period moving average on the SPX either. So, but how come there's big percentages? It's because they were way far below their 10-period moving averages, and some of them have come back up, showing big percentage movements, but they all don't represent or show what the index does or the industry group. Now, some being stronger than others, and we can see that. SanDisk is still in trend 1. CRWV is in 2. LRCX, 2. Trend 2, we do not get very often. To get to trend 2, you have to typically get to trend 1, price below both moving averages. Trend 2, price above the 10, but below the 30. This could be what we talk about, that diagonal reversal in the shorter to intermediate term. Okay, now, James, you said you're going to talk about cash secure puts today. Why? Well, because usually if you've had some sell-off, volatility tends to be a little higher. Volatility higher, stocks actually down to some support levels, higher potential, higher volatility, higher premiums, lower break-evens. Might be interesting. I want to talk about some of the nuances there. Now, if we were to pull up just real quick, a couple things that we want to kind of keep an eye on. Now, I want to kind of show just real quick kind of some of the movement. I'll talk more about this tomorrow. We saw the US dollar, okay, I would say it was a pretty good walloping, okay, a good 1% drop. The Fed kind of talked about they did not raise rates. They did not really create a hawkish stance. They just kind of said, hey, we're going to really look to kind of get inflation under control. That's what the previous person said. Anyway, still haven't done it. But the moral of the story is that's what they said. The market took that as they're probably not aggressively going to raise rates. If they're not going to aggressively raise rates, some of these growth areas bounce back. And you actually saw the US dollar down, among other things. If US dollar goes down, what are you thinking? Maybe precious metals up. The strongest precious metal is copper. Probably second, you would say, is actually steel. When you look, think of teeter-totter, right? If the US dollar actually goes down, commodities, right? But it's also, think of the other fiat currencies out there that could just go up, not because they did something, but because the US dollar weakened. Think of teeter-totter. Now, if I were to also bring up just real quick, we don't even see the VIX. We barely seen the VIX all week crack 20, and that happened just barely. And we're still not really seeing high volatility. And this goes back to riding bullish trends. If we see the VIX lower, there's probably some trends, bullish trends, somewhere. Now, I want to say something just real quick is, when there was some fear earlier this week, we did see staples go to the upside as people kind of headed for some safer potential ground. And now growth fires back and you see it flag back. Oh, it's sad. Now you got to remember what we said before is we're building a portfolio where we have 3 to 5 sectors. Some growth, technology and discretionary. Some also being in the areas of utilities, staples, healthcare, real estate. We want to know if growth is strong, could we benefit? But also, could some of these that tend to be kind of more conservative, could we have maybe a little bit of both? If both are going up, growth, value, and income, if we combine value and income together, that can happen. But earlier this week, you really saw value and income hit highs. High dividend hit a brand new high here today. Please tell me you saw that. Okay. Now, let's kind of talk about some examples. Now, there was a question earlier on Microsoft. And also, I want to kind of now talk about that cash secured put for just a second. Now, when we do the cash secured put, we're really saying, look, I'm going to take a position. I'm going to sell the put at a strike price where the investor says, I don't mind in owning the shares. Now, that sounds fine. But the thing that we got to be a little careful of is like, what's the risk? Okay. Now, if we looked at this, if we were learning this to begin with, we probably would be careful on bigger dollar stocks, like stocks over 300, because if we sell a put on, let's say, Microsoft for $455, example given, it's $45,000 worth of stock. Okay, now here's the deal. There's a lot of people that have a lot of money, okay? But if we were brand new, we had $10,000, doing a cash secured put, we might not have the capital to do that, okay? And if we got a sign, which means we're buying the shares at the strike price, prior to expiration and or expiration, we don't have that much money, okay? So be aware of different strategies and the risk differences. Now, I'm going to kind of show the example of the IRA account, and we're going to kind of show some of the differences here. Now, Microsoft announced earnings, 474. The expectation was, the actual was 474. The estimate was 420. Sometimes you can even have the actual greater than the estimate, but the stock still goes down. There could have been stuff on the conference call that made investors nervous. The forecast actually was adjusted maybe down, okay? Or there was some of the bigger investors that decided to sell their position or a chunk of it on the earnings day. If you were the institutional investor, greatest chance to sell big positions is on the earnings day when the volume tends to be artificially high. Okay, so if you're trying to sell, you're trying to use the earnings day to sell big positions without as much price impact. That's the goal. Okay, now I'm going to come to the trade page and just for here. And what I'm going to do is, so the one thing we've got to understand is when we sell the puts, you got calls on the left, puts on the right. the first thing that we're looking at is what is the spread? Okay. Now, whenever we look at positions, stocks, we wouldn't even think about it. If it doesn't trade an average million a day, wouldn't even think about it in our examples. That stock volume could translate down to the option volume. Then it might have a potential greater chance that the options might be liquid. But the starting point is the stock liquidity. Now, when we actually come down into the options, we see 65 cents on that one, 30 cents there, 35 cents, and so on. Okay, now, first thing what I want to kind of throw out here, how far do we actually want to go out? We show the example going, let's say, 20, 50 days to expiration, monthly options that we start with. Now, if we just came in and said, hey, I want to sell this, and I'm going to use the example given of the 440. Now, the strike that we normally pick is usually looking at the graph and saying, where do we think the stock could stay above? If we don't want to look at the graph, we could actually say, look, I'm just going to pick the strike where we look at the row where the delta is showing a statistical probability of the stock being a penny below the expiration. Excuse me, the strike price at expiration. So right now, if we looked at the 440, it's saying 32% chance to be 1 penny below that strike. What kind of maybe that we don't realize sometimes is that sounds like really good odds that, hey, 32% chance it won't be, okay, or could be below that strike price by a penny. But that does not tell us that from now to expiration, it might go down below that. So just doing quick numbers, you'd always want to go look at this and say probability of touching, okay? Now this is where we kind of get a little little dosage of cold water here. It's like, wow, good. 32% chance will be, we could be 1 penny below the strike at expiration. But from the time that we place this trade until expiration, they're telling us there's about a 69% chance that we could come down to the 440. And what does that mean if that happens? That we could be most likely losing on the position. So if we're at 455 right now, and that stock comes down to 440, you could kind of do the theoretical price, and we could actually kind of do this math and say, well, wonder if it does come down $14. Now, if we come down faster, there's more damage, right? So if today the stock goes down $14, the current price right now is about $8.55. But if we come down $14 in the next hour, all of a sudden those options go to 14. So if we sold it for $8.50-ish and now it's at 14, we're probably upside down $550. We're down $550. We haven't lost the $550. We have an unrealized loss. So we're down. We haven't realized it yet. The obligation has not changed. Still the buyer of the shares at the strike price from now to expiration. Now, the first thing I want to get out is if the stock actually goes down, okay, one of the things we got to understand is if the investor just does this by itself, sells the put by itself, you're going to now notice that the risk is all the way down to zero. Okay? Here's the deal. Even if you said, James, I have $10 million, it doesn't matter. It might, okay? You might just want to take that off the table and know that, hey, we're going to try to take that $43,000 off the table by buying a put that's out of the money. Now, we don't think that put will probably have a high chance of being ever worth something. But normally what we talk about is just say, hey, look, if we sell the 440 and then buy the 405, so trade number one, we're going to go sell the 440, buy the 405. Why? Well, so what we're really wanting is we want the premium from the 440. That's what we want. But just in case that all of a sudden the trend does not go in the intended direction, we're trying to buy the put below at 405. Now, what's the bad part? The bad part, it doesn't make the credit as big. The credit is 845, but if we buy the put with a delta of 10 or less in the same expiration month, it doesn't make the credit as big. However, when we now actually bring up what is the max loss, the max loss is 2847. For some investors, whether they have 100,000, million, 10 million, 20 million, they might just say, look, I'm going to do that because I don't want to have the risk of something going all the way to potentially zero. Now, so that's first, and that's doing it at the same time. The other con of that trade is your time decay is not going to be as high. The other thing to actually kind of note just real quick is we're not planning that 405 is ever going to become worth something, but if it did, we're a buyer at 440 and a seller at 405. And that's where the max loss comes in. Now, let's cut. So that's first thing. Okay. So I would say this, selling cash secure puts by themselves. If you had, let's say, more than 3 positions and there's no downside protection like a long put, you got to really be careful if you had more than 3 positions. The reason why that is, if you had 3 semiconductor stocks that you did cash secure puts on and they all fell down simultaneously, you're not at max loss, but it becomes a painful situation, right? Unrealized loss. Now, let me show you this, okay? So let's all of a sudden say you sell the put, 3 days later, all of a sudden the stock it starts going down. And I mean, it goes down. Now, option number 1 is, could you actually come in here and say, look, I want to get out if we get at or below a certain price? You could, okay? Let me show you this just real quick, and we're going to do some trades based on what I just talked about. If I did this, if I right-click, and if I go sell, custom, and I'm going to say with stop. Now, what you're now going to notice is, this is how someone who says, look, I'm just selling the put only. I want to have an exit, though, if we went at or below a certain price on the stock. Well, we would just go stop market data GTC, okay? And notice there's no downside protection. If we came in here and actually said, what would be the risk? The risk is all the way to 0, okay? I showed both ways, okay? Of these two, there's reasons to use both, but if I came in here and said, look, if Microsoft cannot hold 435 from now into expiration, get me out. Now, the con about this is, if Microsoft goes down to 435 and then bounces back up, you lock in the potential loss. Do you understand that? You get that? Okay. So the first thing that I've talked about is that if you sell the put and the investor maybe has 3 or less positions on cash secured puts, they can sometimes try to ride those positions out. Okay. But it could be, in the short term, some pain, seeing if the probabilities will play out. Now, so trade number 1 was sell the put and then buy that downside protection. Downside protection, you don't think it's ever going to become worth something, but just in case. Second, sell the put, but then have an exit if the stock were to go down to a certain price, which you specify. Con about that is, if it goes down to that price, buys back the option, but it doesn't necessarily mean it can't bounce back up. Why do you say 3 trades or less? Because if you did it, and I'm just saying in general, in our paper money examples, if you did 3 trades or more, let's say you had 10 cash secured puts, and they all go down like semis, a lot of your capital in the portfolio is going to be all tied up for the potential buying of those shares at the strike price. So the con about, like if you said, I got 10 positions like that, all of a sudden you feel like your hands are tied and you don't have any control of what's going on. Oh, it's just going down, 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 just every day. My gosh. Where's the bottom? Adrian. Okay, that's what it feels like. Now, James, do you know that? Yeah, come on. Really? Okay. Now, so let's actually kind of go back to a third situation. You sold the put and the stock's actually going down. You want the ownership. Okay. Now, what I'm going to do is this. I'm going to come in here and I'm going to sell the put in, I'm going to have to do it in the margin, okay? If I did it in the margin and we sold the put, and let's just say that stock actually goes down, okay? But you said, hey, look, I have an over position size. I don't have probably more than 3 positions, and I do want to really see if I can't get to own the shares at the strike price. But in the meantime, I'm wanting to have some defense. I'm trying to protect the position. Okay. So we talked about those 2 things already. Okay. Third, what is another way? Well, one other way is to do a short call vertical. Okay. Now you got to remember is that, tell me, just so we're clear, if the stock goes down, what should the delta of the put do? What should it do? Well, the delta of the put should increase. And it's going to make it feel like the losses are becoming bigger because they are. Okay. So all of a sudden, let's say, hey, the stock in the short term breaks the short term support level, then breaks the moving average and so on. And the investor says, what are my options? Probably some of the cheaper options outside just coming in here and buying a put. The buying the put is a decent option, provided that the implied volatility is not too high, because then the puts would be too expensive. And the put that you buy might be, if you're late to put it on, that might be more than the credit that you even got, which is probably what some semi-investors realize lately. But what, okay, so I don't have the capital to do that. I'm not willing to do that. And if I buy the put, that's going to nullify the credit I have. Okay. Well, what some investors might do is they might say, James, I'm seeing the price go down in the short term. I'm going to come over here on the other side, and I'm going to do maybe like a short call vertical. Now, this is the last thing I'll say on this, but we kind of talked through this about if we wanted to, we could come over here on the right-hand side, left-hand side, go sell, and then do sell call vertical. Now, here's the thing. You have to understand, on the put side, you had about a 32 delta, okay? Positive. If you do a call vertical, you're probably only going to have about a -5 to maybe -10 delta for that short call vertical. So is it really going to offset completely if the stock actually goes down? Just say no, okay? The investor's probably going to need 2 to 3 contracts of the short call vertical for every one that they're actually short on the put side. That's probably at a minimum. Because if the stock actually goes down, the delta of the put is going to increase more and more and more. Is the short call vertical ever really going to offset completely the put? No. Okay. But you're trying to just weather the storm of volatility. So the first thing to think about that short call vertical is don't think one contract. That's going to be like a Band-Aid on a broken leg. Okay. The investor is probably going to think 2 to 3 contracts. Even that is going to be light, especially if this all of a sudden the delta of the put goes to 50, goes to 60, etc. Why is the investor doing this? Well, on a few positions, maybe 1, 2, or 3 positions, the investor saying, I'm trying to be long, get long the shares of the stock at the strike price, but boy, it's painful right now. And I'm trying to make some money over here, which could potentially help lower the break even on the short put vertical, trying to increase the chances of being above that break even expiration on the put strike. Now, I'm going to stop right there. But I think that's probably the most probable. Okay. So number one is selling a put by itself, even if the investor had a capital, they might say, I don't want to risk it all the way down to 0. How do you change it? Consider buying a put with a delta of 10 or less. Does it have to be a delta of 10? No, you might go lower. The reason why we go delta of 10, we don't want to pay a lot for it. And if we don't pay a lot for it, the credit's higher, lower break even. Second, so on most, if not all positions that we're going to show, we're going to buy a put out of the money. Okay. Now, second, if you said, I don't like that, I want to just have a conditional order to exit if it goes down, fine. The con is you're not letting the probabilities play out. If you get short the put and the stock actually starts going down and you truly do not have more than 3 positions because you're trying to protect some of your capital, that everything in the portfolio is not about this couple trades, short call verticals might be the most, well, inexpensive way to try to offset some. I'll just say this. This is more advanced, but someone might say, hey, James, a short synthetic would be another way. And I'm also going to say short stock, but I'll just leave it at that. That is getting into the deeper waters, but those are kind of more direct ways to try to offset the delta on a short put position. I think for many investors, they might say, look, a short call vertical, maybe a long put vertical, etc., to try to offset in the short term. I cannot say this enough. If you have more than 3 positions, you got to be careful. Okay. More than 3, you really feel like you become emotional, you become hostage emotionally to what's happening in maybe a very small section of the market sometimes. Be careful with that. Okay. Now, if we actually go back to, I'm going to go back to also just real quick Amazon. Okay. So trade number 1 was Microsoft. Trade number 2 that we're actually going to look at is Amazon. Now, if we look at Amazon just real quick, we can't say the trend has been unbelievably good. Okay. It's kind of been negative. Okay. Now, I'm going to kind of show this maybe as an example of selling a put that has earnings after the market. And let's kind of look and kind of talk about this. Well, wonder if it goes down tomorrow. And maybe could we do like a short call vertical, etc. Okay. But initially, what I'm going to do is show what we talked about at the beginning. We're going to go into the Amazon. Now, if we want to kind of have something where we can kind of let the probabilities play out a little bit more, we might not go to the 22 days to expiration, because wonder if in the next 2 weeks it's just horrible. It doesn't give you a whole lot of time for it to bounce back. Now, if we went out to, let's say, 50-ish days at the high side, could we look to maybe sell a put there? Now, the problem with actually going out that far is, what if the trend just keeps going down? That's fair. That's a fair comment, okay? But if we went to, let's say, the 18 September, I can't even believe I'm saying that, okay? If I went to this and said, look, I'm going to sell the 225 with a delta of 30-ish, but I'm going to buy that put out of the money. How do we do it? Now, let's do this a little faster, okay? So if we sell the 225, delta of about 32, buy the put with a delta 10 or less, it's the 195. So what is this going to look like? Right click on the 225, sell, and then go actually the 195, okay? Now here's the deal. Let's just say all of a sudden, I mean, just Amazon gets absolutely worked over. I mean, goes down to 150, just horrible, okay? Well, you got to remember, by doing that, what has the investor really done? The max loss is built in. Don't like it, but at least it's not down to 150, where the losses are probably in the magnitude of $5,000 to $7,000, $8,000, okay? Where the losses could be cut by probably over half, okay? If the investor just sold the put only and the stock went down to 150. Now, again, by buying the put, the credit is going to be about $1.70 less, but the investor might say, James, that seems worth it to me if I can take the max loss, as big as max loss, off the table, okay? The other con that we have not said is, are you willing to pay 65 cents to not have the risk all the way down to zero till expiration, and at the same time have a smaller max loss? Some of you might say, that was one of the dumbest questions you've asked so far. I just had to ask the question, okay? I have to show both sides. I know. Sometimes you're like, wait, that doesn't really seem like a con, considering what the plus could be. All right, now, if we go back to this just real quick, if we look at this market maker move, $17. So if we look and kind of see the $17, this is $17 up or down. $17 if it went down, that's the forecast. would get us at the strike price, the stock price of 220. We have the 225. The break even at expiration, not today, is at 218. All right. That James, in all your time of I started investing in 1996. Okay, July of what? June of 96. Okay, I've seen bull markets, down markets, sideways markets, financial crisis, the whole 9 yards. At first you try to trade things, but then over a while you start to see kind of there is some real interest in the mathematics of letting the probabilities play out. That's how some investors they might come to that. But you got to understand that some trades could be horrible. And that's why if you do you have short puts, trying to keep those number of short puts to something manageable. And where it's not, if you had 12 positions in your portfolio and you had 3 short puts, you still have some other trades that you could do, and everything's not tied up in these short puts. Okay. Some of us have been there and done that. Send that trade. Okay. There it is. Now, if we take a look at this, any questions? Okay. Now, just real quick. Yeah. So we know that Amazon has earnings after hours. And the reason why we're trying to do Amazon after hours is because it does have a higher implied volatility, 42. Okay. We're going to look and kind of see, could it pop to the upside? I mean, that it is a bullish trade. But if this were to go to the downside, could we try to defend the position and follow through on what we talked about? So if this does not go bullish, we're going to try to do a short call vertical and overlay it on that cash secured put. Okay. Now, let's also go to some other examples. Let me know if you have any other examples or questions. Now, one thing I want to kind of say just really quick is I also want to say the other stock that actually has earnings this afternoon is Apple, and you're going to see it right there. Now, one of the things that we've seen in Apple is we've had a big run from 275 to 344. To say that there's pretty high expectation is probably not telling the whole story. There's some pretty high expectations of what these earnings could be. Now, the one thing is, sometimes even if they come out with unbelievable earnings themselves, investors have already bought in anticipation of that. It's kind of like your spouse marrying you. That's why they married you. They had high expectation. So did my wife. My wife still keeps those high expectations. I try to remind her, don't have such high expectations. She doesn't listen. Okay. Now, if we take a look, she's not here. So don't tell her I said that. Now, here's the deal. If we go back to, let's say, the trade, okay, what I'm going to do is on this, if the investor says, James, I think there's some pretty high expectations, and I'm going to sell a call vertical above where we are right now, thinking the price might be neutral to somewhat down. Now, that's the direction. The other thing is here, did anyone laugh at that? You should, okay? We all have a little fun. Oh, come on, we're raising a family. I got 4 kids, a dog, there's a lot going on. Now, here it is. So we're trying to trade the direction of neutral to down, but we're also trying to kind of maybe see if the volatility could contract. Okay. Now, yeah, no, she's not here. And we, that's a good thing about my wife, Amber. Okay. She could take a good laugh. And hey, you're married we celebrated our 30th anniversary. Whatever anniversary we actually are celebrating, we're always ahead. So next year we're going to do the 35th. The next year after that, the 40th. Because we're always setting a target of where we're going. That's not a bad idea to do. All right, now, setting a target. Now, what I'm going to do is I'm going to right-click on that, sell, and then vertical. Now, this is not to say that the investor can't be somewhat bullish. This trade is not bullish, though. It's actually saying, look, the stock's at 332. If we sell the September, the 350, 355, or the 350, 360, You're now going to notice there's the credit of, let's say, 260. If we got somewhere in the middle, we're probably right around, let's say, 250. Okay. Now, here's the deal. So the break-even expiration, and this is at expiration, is 352. So the stock can go up about $20 more to get to the break-even. But if we're higher than 352 at expiration, we're losing. Okay. Max profit, max loss, given the vertical, and there's the credit. Now, so James, let's say the stock actually goes up $5. Is it all bad? No, that volatility is probably going to offset some of it. The way that this trade would work bad is the stock actually goes up, but the volatility doesn't really drop. Now, that's usually not the case. We'll find out tomorrow morning. We'll look at this on ETFs tomorrow, kind of see where the volatility is. Remember the volatility of 29, okay? We're going to go ahead and send the order. There it is. Now, if we take a look at this just real quick, now comment was Apple raised prices on nearly all its products. The one thing that we would have to say on Apple products, they hadn't really raised the prices. If you go back the last 10, 15 years, they didn't really raise the prices for like a long time. I'm talking about the last 10, 15 years. If they went back the last 10 or 15 years, the iPhone, let's say it was $999 and now it's like $1199. Oh, I mean, it wasn't that much if you really annualize what that percentage increase was over time. But with some of the storage demand costs, et cetera, the chips, as they actually started making their own silicon chips, not Intel's, many users might say the product was better and they don't mind to actually pay a higher amount. I said this before and I'll say it again. Who on earth buys an Apple product if they were looking for something that was not as expensive? Okay, probably wouldn't buy an Apple product if you're looking for something inexpensive. Okay, now, if we went back to just real quick, any other questions? Yes, Pia, thank you. I'll tell her you said that. Amber is a real trooper. Look, she's called me special a number of times, and I asked questions, but she didn't give me any answers. Now, if we take a look at, let's say, Datadog, one of them that we have to kind of say that's been a little awkward to this is Datadog hasn't even gone down. Datadog is one of the few that's actually been up and up still near resistance. Okay. And if you take a look at this, that has earnings coming up, but I'm just going to say, keep an eye on this. It's on August 6th, which is going to be next week. Okay. Keep an eye on that. Now, the other ones I want to kind of say keep an eye on is WDC. Now, some of you, you might be saying, well, James, why wouldn't an investor just go in and do some bullish trades on WDC or whatever? You need to check the spreads on those options if you were to do options. When I looked before this class at some of the option spreads on some of these semis, they were $7 wide. Okay. So you have to check that and say, really, how realistic is that? All right. Now I'm out of my time here today. We're going to continue. So tomorrow morning on ETFs, we're going to come back and talk about some of these on the ticker symbol of semis. Okay. We'll also kind of talk about how the US dollar drop could have sparked some of the other areas, like in commodities, currencies, also in the areas of international. Okay. When we kind of see the bigger picture, you'll say, wow, that's kind of interesting. Okay. But the big takeaway from our class is we're not just talking about growth and growth only. As I made mention of, income and value is still a focus. The con about income and value is when growth pops back up, you can sometimes or could see income and value drop. But you got to remember is if you get any volatility event, those investors could try to come right back in. That is why there's a balanced approach to growth, income, and value. Now, remember that we have Brett Crowther coming up next. I want to say thanks to Connie Hill for answering those questions in chat. Thank you for the nice words. And Pia, I will absolutely tell my wife she deserves a trophy. I agree with you. Okay. All right. And remember with what we talked about here today, we also kind of focus on cash secured puts, some of the risks to those. And we also tried to actually kind of set up an example of Amazon saying, hey, can we practice how to sell a short call vertical against the cash secured puts if that trade starts going against us? Remember with what we talked about, all investing has risk. And also remember that position sizing is key to kind of trying to minimize the risk to begin with. With that said, thanks so much for talking about trading the trend. And always remember what trend are you riding. Stay tuned for Brett Crowther coming up next. Don't forget to hit the thumbs up and subscribe as well. See you back tomorrow morning at 9:30 on ETFs. Take care. Bye-bye.